Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shandong XINHUA Pharmaceutical Company Limited annual report. Shandong XINHUA Pharmaceutical Company Limited offers a diverse range of businesses and services across various industries. The company develops, manufactures, and sells bulk pharmaceuticals, preparations, and chemical products globally. Under its XINHUA brand, Shandong XINHUA provides antipyretic and analgesic, cardiovascular and cerebrovascular, anti-infective, and central nervous system drugs. It also offers contract manufacturing services for active pharmaceutical ingredients and intermediates, over-the-counter, OTC medications, and generics. In addition to its pharmaceutical products, the company provides a wide range of chemical products, including raw materials, intermediates, antibiotics, biochemical medicines, anesthetics, antipsychotic drugs, and pharmaceutical precursor chemicals. Shandong XINHUA also offers prepared Chinese herbal medicine for decoction, traditional Chinese medicine, and protein assimilation preparations. The company's services extend beyond manufacturing to include internet data services, internet sales, and information services for pharmaceuticals and medical devices. It also exports and imports goods and technologies, designs medical projects, and engages in property management, non-residential real estate leasing, and housing leasing activities. Furthermore, Shandong XINHUA provides veterinary drugs and fodders, bulk pharmaceutical and intermediates, steroid system APIs and intermediates, and chemical raw materials. The company also manufactures mechanical and electrical equipment, non-standard equipment, production and hardware and electrical equipment, and electrical installations equipment. In summary, Shandong XINHUA Pharmaceutical Company Limited offers a comprehensive range of businesses and services across the pharmaceutical, chemical, and manufacturing industries. Shandong XINHUA Pharmaceutical Company Limited maintains a market capitalization of $10 billion, broadly in line with the industry peer group. Shandong XINHUA Pharmaceutical Company Limited trades at a higher price-to-earnings ratio of 13 times and a lower price-to-book ratio of 0.75 times relative within the industry. This suggests a potential market detachment, as Shandong XINHUA Pharmaceutical Company Limited trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 41% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 8.91%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified from the extracted summary. On the growth side, several factors contributed to the increase in revenue. The company's international pharmaceutical preparation business grew by 19.86%, while export sales of self-operated preparations rose by 176.13%. E-commerce sales revenue increased by 12.86%, and animal drug preparations sales revenue rose by 67.12%. Additionally, the company obtained a new medical device manufacturing license, made significant progress in export volume of starch granule series products, and achieved a record high of 47 drug approvals. The growth was also driven by internationalization, with emerging markets in Japan and India contributing to the increase in revenue. The leverage of e-commerce platforms and capabilities also played a crucial role in driving growth. Furthermore, the company's main operation revenue increased by 3.4%, while other operation revenue grew by 6.5%. On the decline side, several factors contributed to the decrease in revenue. Selling expenses decreased due to normalization of national centralized procurement, resulting in a minus 41.67% change. Non-operating income also declined due to write-off of long-term liabilities, with a minus 36.15% change. The company's operating profit, total profit, and net profit declined due to proactive reaction to market competition. Preparations sales revenue decreased by 10.22 percentage points, while Americas and Europe regions experienced declines in revenue. Direct selling also saw a decline of 7.97 percentage points. Overcapacity in the domestic pharmaceutical industry and intensifying competition in the domestic market further contributed to the decline in revenue. The net income of the company experienced a significant decline between 2024 and 2025, decreasing by 37.07%. This downturn can be attributed to several factors, including increased financial expenses due to exchange rate fluctuations, which rose by 184.77%, as well as reduced selling expenses, down by 41.67%, and decreased non-operating income, which fell by 36.15%. The profit margins of the company also underwent a notable change during this period. The net profit margin dropped from 9.79% in 2024 to 5.66% in 2025, while the operating profit margin declined from 6.33% to 4.16%. These decreases can be linked to the company's proactive market expansion and price reductions in response to severe competition. As a result, both total and net profits decreased during this time. The company's financial performance indicates a strong ability to generate cash from its core operations. A key indicator of this is the net cash flow generated from operating activities, which has been consistently positive. In fact, according to the latest figures, the company has recorded an impressive 533,728,707.74 RMB yuan in positive operating cash flow. This suggests that the company's business model is generating sufficient revenue to cover its operational expenses and produce a surplus of cash. As a result, the company is well positioned to invest in growth initiatives, pay off debts, or return value to shareholders through dividends. Overall, the company's ability to generate positive operating cash flow is a testament to its financial health and stability. The performance of various regions and segments in a recent analysis has revealed some areas that require improvement. In terms of poor performance, Europe and the United States have shown subpar results, as indicated on page 16. Additionally, domestic preparations have also underperformed. On a more positive note, there are opportunities for growth in certain areas. The API segment is identified as having potential for expansion, as mentioned on page 16. Pharmaceutical intermediates are also seen as a promising area for growth, further highlighting the need to focus on these segments. The company's financial performance and shareholder benefits are outlined in the provided summary. According to the information, the company has a history of paying dividends to its shareholders. Specifically, it is mentioned that a dividend of RMB 0.15, tax inclusive, per share will be paid to shareholders. A review of the supporting pages reveals no mention of share buyback initiatives by the company. This suggests that the company's primary focus in terms of shareholder benefits has been on distributing dividends rather than repurchasing shares. There are concerns about inventory buildup and supply chain disruptions in the pharmaceutical industry. The high inventory turnover rate of 548.85% suggests a potential issue with inventory management. Furthermore, overcapacity in the domestic market and restructuring of industrial supply chains may lead to supply chain disruptions. The decrease in operating profit rate and gross income as a percentage of sales for certain preparations also indicates potential issues with inventory buildup or supply chain disruption. However, it is worth noting that there are some contradictory signs, such as the decrease in inventory impairment loss on page 33, which suggests some improvement in managing inventory levels. That concludes the financial summary for Shandong Xinhua Pharmaceutical Company Limited. Feel free to comment below, and I will be happy to answer them when possible.